So check out Norwegian Cruise Lines. This is a business that's got an ROE of 95%, by the way, or return on equity of 95%. So they're compounding book value quickly. But why is the ROE 95%? The ROE is that high because they have lots and lots of debt, lots of debt. Okay. So high ROE alone doesn't mean it's a good metric. You can have high ROE, but if you have too much debt and you can't pay your bills, then that can be bad. I'll come back to that. So what I want to do is this. I want to validate first that, hey, is this business actually compounding book value? This is an excerpt from the Lumina Ledger this past weekend. You can see the total common equity. This is the book value. This is actually how Warren Buffett would look at a business. He wouldn't buy this business, by the way. I think it's too cyclical for him, but that's okay. So in 300 million in common stock in book value, book value in December 23, December 24, 1.4 billion in book value. That's strong growth. That's due to the high ROE, right? Now, book value is your total assets less your liabilities. It's one way to think about compounding. Right? If you own a compounder, you should be looking at the growth in the book value. It doesn't mean that's intrinsic value. It doesn't mean it's market value, but it's a good sanity check. Are these at least creating accounting value? They're creating accounting value, according to this. The book value is compounding. I can see it growing. The higher ROE is expressing itself in higher total equity. So I like that. So far, so good. So what about this debt level? So we look into that. First thing I do is look at the short-term debt, the debt that is payable in the next 12 months, and you got to make sure they can meet their bills. So we want to look at available cash on hand, and we want to look at what comprises that. So we look into this, we said, gee, half of Norwegian Cruise Lines short-term debt are customer advances. That's not a fortress credit facility. Half of their short-term debt are customer advances. In the same way that if you make a deposit at a bank, you've made a loan to the bank. Your deposit is a loan to the bank. That's not bad. It's great when the bank gets your deposit. They turn around and they can make a loan, and that's how the bank makes money. And that's why banks have pretty good business models. Those are prepayments, actually. So short-term debt is elevated because of customer advances. Now, the other question is, again, can they pay off the debt, though? We can measure that. You can look at their debt payback yield. So I'll pull that up here, and we can see that they're paying off about 5% of their debt each year. Again, this business does have a lot of debt to equity. So I don't want them taking on more debt, but they are paying off their debt. I want to see that. Do they have enough free cash flow to pay off their debt? If they want to increase that, or are they running on fumes, or do they have freedom to maneuver? And this is one of my favorite charts, by the way, is the free cash flow yield of a company. I look at this every name I invest in. It's a very crucial chart. You can manage earnings. It's hard to manage cash flow. This is the free cash flow yield divided by market cap of Norwegian Cruise Lines. It's around 11%. And you can see it's rarely been this high for this business. It's rarely been this high for this business. It's a way to measure value. They're paying that debt down. We have plenty of free cash flow to keep doing that. So check. This is important because you got to make sure the left tail risks are protected. You got to make sure the left tail risks can be managed. If you solve for that, then good things should happen with this business. That's how I look at it. Your primary left tail risk is COVID happens, another COVID lockdown. If you cannot cruise, then these stocks, all of them will get hammered, like they were hammered during COVID.